Welcome to Talk Tickers, where we break down the earnings calls that move markets. Today, we're dissecting Gray Media's, ticker GTN, third quarter 2025 results. So, on earnings day, November 7th, this thing was a roller coaster. The stock actually opened down, but once investors really started to dig into the numbers, it just took off, surging as much as 17% during the day. But here's the kicker. Management also guided for a pretty weak fourth quarter. So the big question on everyone's mind is, was this pop a real sign of strength, or was it just a classic value trap? Okay, let's dive in and find out. All right, so first up, let's unpack why the market reacted so strongly to those headline numbers. Okay, first off, Gray delivered a really solid adjusted earnings per share beat. We're talking 13 cents better than expected. They came in at negative 20 cents when the consensus was all the way down at negative 33 cents. I mean, that's a nearly 40% upside surprise. Pretty impressive. And it wasn't just on earnings per share. Profitability was also a huge beat. Adjusted EBITDA hit $162 million, absolutely crushing the street's estimate of around $139 million. Just a massive beat there. But you know, the real story, the thing that likely got everyone's attention, was all on the expense line. It really came down to management's impressive cost discipline. Get this, total operating expenses came in $17 million below the low end of their own guidance. That's a huge signal to the market that their cost-cutting measures are really taking hold. So when you put it all together, here's the picture. Yeah, year-over-year revenue was down, but that was expected because of some really tough comps against last year's political ad spend. The important part is that Gray beat expectations pretty much across the board, on revenue, on earnings, and especially on keeping those expenses in check. So you can see why the market loved the execution, right? But, and this is a big but, the story gets a whole lot more complicated when we start looking forward. And right here, this captures the central tension of the entire call. You've got this awesome Q3 performance, and then, bam, they follow it up with some pretty weak Q4 revenue guidance. Their midpoint was about $774.5 million, which is way below the street's estimate of $813 million. A big miss. Now, this week guidance isn't just happening in a vacuum. It's really set against a tough backdrop for the entire local broadcast industry. I'm talking about the usual suspects: ongoing cord cutting, constant pressure on retransmission fees, and an ad market that's, well, pretty sensitive to the broader economy. So what gives? Why the big disconnect between a great quarter and a soft guide? Well, management is basically telling us to think of 2025 as a transition period. Yeah, they're calling it a bridge year. The whole idea is to use this time to strategically reset their costs and get the balance sheet in shape, all to get ready for what they see as a cyclically massive 2026. And this bridge strategy really rests on four key pillars. First, keep that strict cost control going. Second, expand their footprint through some aggressive M&A. Third, innovate with a new streaming platform that's set to launch in January 2026. And finally, keep shoring up that balance sheet. And what's the big payoff for all this bridge year work? It's all about the 2026 political cycle. And listen, CEO Hilton Howell was not shy about it on the call. He put it in no uncertain terms. Okay, so the thesis is crystal clear, right? Endure a little short-term pain in 2025 to cash in on a massive 2026. So what does that mean for the stock right now? Well, that brings us to the next call, our forward-looking take based on everything we just heard. All right, so for Q4, we're expecting revenue to come in pretty much in line with their new lowered guidance. It seems like management's conservatism is now priced in. As for the stock, we see it staying range-bound for a bit, as the market will likely want to see some tangible proof of that 2026 thesis before it makes a big move. And for that reason, we're giving Gray Media a rating of market perform. Look, the company is executing really well on the things it can control, but that powerful 2026 political story, it's just a little too far out right now to overcome the headwinds we're seeing in the near term. So the final thought we want to leave you with is this: what catalyst out there could actually accelerate that 2026 timeline? What could shift this stock from a wait-and-see story to a buy-now thesis? And just a quick reminder, this is not financial advice. This analysis is for informational purposes only.